for the index. And whenever we create indexes, these indexes are models, right? And these models are written for us at NASDAQ. Most of our index models are written in R. And that's a good skill to have when you're in this role. And once we have the indexes ready, we collaborate with, or I'm collaborating with partners to tell them about how the process have been going and if they have any concerns or comments with regards to the index launch. And the skills that would be needed for this kind of role is a mix of quantitative as well as qualitative. You need a good understanding of financial products just in general. And I feel like the degree at Baruch for the finance program does give you a very good, well-rounded understanding of just financial products in general. You don't need to be in-depth expert at all. I wasn't either. And you learn a lot in the role, but they do expect to have good knowledge about fixed income, derivatives, like options, like just basic finance acumen. And because in this role, I'm actually writing the methodologies, they want you to have strong attention to details so that you're able to write the investing strategy in common language and in a very easy to understandable way into the methodology document. And because you're working with partners, right? So the client can be First Trust. They have a fund that they want to track our index, and you need to communicate with them on the progress of the index, or if there are any, roadblocks or challenges in the process that comes. And because the models are written in R, you do need programming skills, but the good thing is that you don't need to necessarily be able to write in R or Python. As long as you can read R code or Python code. And now with, ChatGPT and so forth, it's always easier to read code. And you can, translate code to regular language pretty easily. And in my role, I'm actually not writing the code or the model for the indexes. I'm reviewing what the developers create, which we will talk about later. They develop the model. I review the model and make sure the model matches the methodology. So what the model does is exactly what is written in the methodology. And therefore, a good skill is to be able to understand the R code so you can actually pick on mistakes that are maybe made in the model so it matches the actual methodology. And the index NASDAQ overall has a very good work-life balance. However, some departments within the company can be a little more hectic. For example, the index business, especially in R&D, it can be a little long hours at some points because you have tight deadlines that are given by the client. Because when a client wants to launch a fund, they usually have to tell the regulators that they want to launch the fund on this date. And by that date, at least a month prior to that date, we need the index to be created so they can put in their prospects that the fund will track this index. So therefore, there are tight deadlines and long hours, especially during the first quarter of the year, because that's when most funds, they want to make changes to their funds. And when they make changes to their funds, we need to change the index to match the fund. And that's why the first quarter can be very hectic. Now it's a little bit slower, so that's nice. I can breathe a little more, but that's usually how it is. There's plenty of resources for career growth. The company is huge and they focus a lot on career growth. So you can easily move around after a year or two within the company if there's a different department that you like. And they have different programs for connecting to mentors. Next slide, please. So now into what indexes are, right? So what is an index? And then I'll talk about the different types of indexes that is generic for the entire index business, not only NASDAQ. But I will give you some example based off each type of index, so you have some reference on maybe indexes to look up after this call, so you can explore, wow, I didn't know they had an index for this strategy, right? But index simply is a benchmark of a fund. So any ETFs, they need an index to track for regulatory purposes. And what the index does is basically it does what the fund does, but it's written out in a rule-based format. So everyone, if they're curious what the fund does, they can look at the index and see all the rules for the index. Like, for example, how does it select securities or companies? How does it weigh the securities or the companies? And what other criteria does the index have? And the reason for this is because regulators, they want to keep fund providers responsible for a strategy. So when a fund says that they are an ESG fund, the regulator wants to have proof that the fund actually does what it says it does. So if the fund says it's ESG, then the regulator says, give me proof that your fund is actually investing in ESG. And the way they prove that is by showing that we track this index, which will be ESG. So that's an overview of what an index is. And index is kind of the starting point of an investing life cycle. So we create the index, then the fund provider, like for example, First Trust, Invesco, they create a fund tracking that index. And that fund, like an ETF, is then sold to institutional investors or retail investors like us. And it goes like a full circle, but it starts as an index, then a fund that is tradable, that investors can access. So that's kind of the circle there. Sometimes we create a new strategy in-house, meaning that NASDAQ came up with a new investing strategy, and we pitch that idea to the fund providers. And the fund providers can then be like, oh, we actually like this investing strategy or index that you created, so we're going to create a fund tracking that index. Other times, it's the fund provider that reaches out to us and says, hey, we have this investing strategy. Currently, there are no index in the market that does what our strategy does. Can you please create an index that does what our fund wants to do? So it can go both ways. So now let's dive into like the different index types. There are 5 common index types. The first one is market capitalization weighted index. And what it does simply means is that, let's say you have 100 companies in that index. when it says market capitalization weighted, it means that the weights that each company in that index or portfolio, if you want to call it, they're weighted based on the size of the company, which is the market cap of the company. And because it's weighted based on the size of the company, larger companies thus will have a higher weight. And an example of market cap weighted index is the NASDAQ 100, which is the largest 100 companies on NASDAQ stock exchange that are non-financials. Then you have equal weighted, which is simply instead of weighting by the size of the market, they basically weight the securities equally based on the number of securities, right? If there is, let's say, 10 securities in the index, each security will get 10% weight. So that's simply what equal weight is. Then you have factor-based. Factor-based means that it's an index that focuses on a single factor, and what that factor is can be many things. A factor can be, for example, it's only large cap companies. So the factor is then only focusing on large cap companies. So the index will only have large cap companies. Another factor can be, for example, price momentum. And an example of price momentum index would be NASDAQ Factor Family US Momentum Index, which looks at multiple momentum factors, but one of them is the price appreciation factor, which is basically looking at how much did these companies increase in value over a specific period of time, and then it creates a strategy around that factor. Another factor can be just looking at dividends. Which companies have the best or highest dividend yield? So again, it focuses only on one factor, and in this case, it's dividends. And an example of that is NASDAQ US Dividend Achievers that looks at the top companies at NASDAQ that has the highest yield. So as you can see, it's based on a factor. So if you, let's say, want to invest in companies with high dividends, you select or go for a fund that tracks that NASDAQ US Dividend Achievers, for example. Or let's say you want to look at companies that have high price momentum, that's your strategy. You go and look at a fund that tracks NASDAQ Factor Family US Momentum Index. The other strategy or type is smart beta. This one is basically the same as factor-based, but this one looks at multiple factors in when it selects securities and when it weights the securities in the index. And an example of that is NASDAQ US Smart Sector Indexes. So this one, you see that it says sectors. So that's one factor. It has indexes that focuses on specific sectors, like, for example, banks. It looks at companies that are pharmaceuticals. They look at companies that are in retail, so specific sectors. And then it uses multiple factors in addition to selecting sectors to select the securities in the index. And some of those factors are, if I remember correctly, they look at profit margins, they look at momentum, price momentum, they look at free cash flow, and they look at also revenue numbers. So look at multiple factors in addition to the sector factor. So it combines, that's what smart beta is really. It combines multiple factors into selecting the securities that goes into the index. So that's where the smart feature comes in. So it combines multiple factors. And then you have, lastly, but not least, you have thematic indexes. These are based off different trends. So it doesn't care about like different factors such as revenue numbers. They don't care about profit margins. They don't care about sector necessarily. They focus on whatever is trendy. And what is trendy right now is obviously AI with ChatGPT. Not as much robotics, but that one too. But another big trend is ESG. So these indexes focuses on securities or companies that are in those trends or are participating in those trends. And for example, one in AI and robotics would be NASDAQ CTA Artificial Intelligence and Robotics Index. This one tracks companies that participate in artificial intelligence and robotics. And for ESG, you have, for example, NASDAQ Clean Edge Green Energy Index that tracks companies that engage in green energy solutions. So as you can see, there are different index types, and the reason why there's so many index types are because there are different investing strategies, right? And the entire purpose is to have an index for any type of investing strategy or almost any type of an investing strategy. So investors can always track an index that is in line with their strategy. Next slide, please. A very interesting one that I have, among others, been working on is an index called NASDAQ IFET indexes. The reason for indexes is because it's a suite of multiple indexes in that suite. And this one is a smart beta index. And because in the past 2 years, right, we have been in a rate hike cycle. And obviously the stock market performed poorly in 2022 just because of the rate hikes, right? Because of high inflation. And a lot of people during this time were all about how can we circulate our portfolio to be less tech companies and more, for example, industrials or banks or other sectors that are less, sensitive to the rate hikes. And this is an investing strategy, right? A lot of people can do that manually, but doing that manually requires a lot of research. It requires a lot of time and effort to kind of time the market based on the rate hikes that are happening. But we actually have an index that does this for you, basically. So this index, IFET index, uses a combination of Federal Reserve policy signals. So whenever the Federal Reserve increases rates by a certain amount, that will be taken into consideration by the index, and it will allocate its portfolio to a specific sector that, based on a lot of research, they know that this sector during rate hikes performs better. And it's because it's a smart beta, it's combining Federal Reserve policy signals and key firm metrics that are fundamental metrics of the company. And below is a chart showing the difference between the IFED one, LTM stands for large mid cap, or I'm sorry, this one is just large cap. So I fed large cap index, which means that it looks at large cap companies that that have been screened for this Federal Reserve and key firm metrics. And that one is in blue, and it's compared to S&P. And you can see that during 2022, during the rate hike cycle, that's when you see it starts to outperform S&P because it basically rotates the portfolio towards sectors that usually do better during rate hikes. And that's just an example of how indexes can also be dynamic, right? Usually you think of indexes as passive investments, but now, thanks to technology and computing power, you can create indexes that are pretty much dynamic, like this one, that looks at live action items like Federal Reserve rate hikes and then changes the portfolio of the index based on those things. And then the fund providers can do the same and hopefully lead to an outperformance, as in this case. That was pretty much it from what an index is and different types of indexes, as well as examples of the different types and how it can actually lead to outperformance based on any type of market environment. So now let's get into the career opportunities in the index business. So if you're someone interested in the index business, there are actually plenty of opportunities based on your preferences as well as skill sets. So you have in the index business, or careers in the index business is divided, as you can see. The first one is R&D, which is the research and developing of current and new indexes. So this department will be focused on finding new ideas for indexes that you can launch, as well as making changes to current indexes based off requests from partners or clients, like, for example, First Trust or Invesco. This is where I am, and this is where you're really utilizing financial knowledge as well as programming skills to actually develop the indexes and research around the indexes. And it's a department where you can utilize your creativity to come up with new ideas, which is very exciting. Then you have the operational side of the index business. These are responsible for maintenance of indexes. That is, when an index is launched, it has to be maintained in the back operations, and that's what the operational team is focusing on. So if you're more interested in something that is less focused on actually creating the indexes, but you still want to work with in the index business, operations can be a good or a nice segment of the index business to work in. If you're more client focused and you like to interact with clients, you like to be in an environment where you're talking more with different parties, and you're doing problem solving, then client services part of the index business might be a better match for you. So here you're interacting with the clients to resolve any issues before or after a launch of an index. And it's exciting for people that really wants to have that interaction on a daily basis. If you're someone that likes programming and likes to actually do coding, most of the time, let's say you're interested in finance, but you're also very interested in programming, then the model team might actually be a better fit. So the model team are the ones that are running and maintaining the models used for calculating the indexes. And that's where skills in writing in R and Python comes very handy, because they're heavily working on in R, and you need to grasp programming very comfortably to work in that team. And lastly, you have the sales part of the index business. So this is, again, for people that like to be in a more client-facing role. But here, instead of resolving issues that clients have, like in the client services, here you're basically promoting current and new indexes to ETF providers to make more revenue for the company. Because we have a lot of indexes that we have created, but not all of the indexes have funds tracking them. So they're just laying there kind of dormant. It's an index, but no one uses it. And because no one uses it, we don't make money. So the salespeople are then responsible to reach out to these ETF providers to make more revenue. And some of them are First Trust, Invesco, and Wisdom Tree. And next slide, please.
Hi. So I'm just going to ask some questions. So what was your major at Baruch?
My major was Master's in Finance.
Oh, and how did you navigate your early career as a student? Like, did you do any internships or like networking events that you would suggest?
I had a very like bumpy start, and it wasn't a perfect kind of growth trajectory. So initially, I had a hard time finding an internship. Why? Because my previous background was not finance related. It was more sales related. And I wasn't able to find an internship the first semester. But fortunately, not in the second either. I think in the third semester, I was able to find an internship at AIG. And that was actually thanks to a friend that I knew that said that she has an open role at her company, which was AIG, and they needed to fill that position. And when I applied through her, that's when I really increased my chances, because the pool of applicants applying to that role was much smaller because it wasn't promoted as much. So that's just an example where really networking or having friends that works at different companies can become very handy, because they might tell you about the open role before it's even promoted on the website.
Yeah, I think a lot of us can identify with the struggle of finding an internship here. I mean, I can do that as well. So, did you always want to be like work as a product analyst, or did you have something else in your mind when you were studying at Baruch?
So I personally was interested in getting into investment banking, where you're actually, or equity research, where you're really analyzing companies and making recommendations, or selects companies to be in the fund based on whatever research that you do, right? But an equivalent to that is actually in indexes. So you do the same, but you just do that for an index, not for a fund. So it's kind of a little bit the same, but it's different from, for example, equity research in the way that we don't analyze the companies in depth. We just think about a strategy, and whatever companies fall under that strategy will be included in the index. While, for example, equity research, they really dive deep in a company and really tries to understand the company financial standpoint as well as growth trajectory. We don't do that. We don't make forecasts of the company, how it will perform. We're just more about the strategy idea, investing strategy, and those companies that fall under that strategy, they will be included. And how I ended up in NASDAQ was kind of random in the way that I didn't apply for the role. A recruiter reached out to me, and when I got the role, I took it because it was somewhat related to what I wanted. And it's heavily financed, so you get to use what you learned in school, and you get to learn more about financial products and just the entire business or the cycle, because you get to learn about the ETF providers, the fund providers, the asset managers at different funds. They reach out to us, so you kind of learn the full cycle, which is very nice.
Oh, I mean, that's great. And how did you land your first job? I think you just answered that for us, that it was through a friend.
Exactly.
And the last question is that what was your biggest challenge that you faced when you were a student and you were transitioning into a professional?
I would say that I remember when I was in school, I didn't really appreciate how this kind of the when you're a student, basically when there's not the finals and midterms, everything is kind of slow. And then when midterms and finals come, it peaks, right? It becomes stressful. It's a lot of work. It's a lot of, trying to get things ready by a certain deadline. And I was personally hoping that maybe in the professional world, it will be more smoother, so you don't have these kind of peaks all the time. But I ended up in a role that kind of have had peaks all the time, almost. So little did I know that it's just going to be the opposite. It's just, at least for some roles, like the one I'm in, it has been very like high intensity for a very long time, which was a big challenge because it can be mentally challenging to basically be able to work long hours and also have a life outside of work and feel content outside in general. So that was definitely a challenge.
Oh, I mean,
Not to scare people, not to scare it.
So now I think we can, if there's anyone who wants to ask Inam some questions regarding his role or anything, please don't be shy. Should I just start away? Because I have some questions actually. So you suggested that like R and Python, knowing how to knowing R and Python programming skills are necessary. So are there any particular programs or courses that you would suggest any student to do that will help us to like get a to get a strong hold on these two programming skills?
Right. So I remember during the finance program, right? You have introduction to quantitative analysis with Piscula, right?
Yes, yes.
And then you have econometrics that uses Python or a combination of Python and R. But what I notice is that those, because you're just doing specific tasks, like for example, calculating t-tests and statistics,
Yes.
right? It's very specific. So you don't really get comfortable with the programming language. You just know the code for specifically that task only almost. So I would say in addition to those classes that gives you at least some understanding, any like videos on either YouTube or like different platforms for courses like LinkedIn Learning or whatever you have access to. Any course that is in those programming languages would suffice. But then you need to kind of build it from intro level to mid-level, and you don't necessarily need to be advanced, but at least know the basics, be comfortable to write code yourself based on different tasks as a bare minimum. But if you want to be in the model team, you need to be almost advanced level for programming. But if you're in the R&D team, specifically in my role, you can do well with just understanding the code, not necessarily writing the code, but just understanding what the code does.
I mean, that's great. I mean, I think I'm at least quantitative tools for finance and econometrics are not going to waste. I have taken these two courses, so it's going to be helpful for me. Does anyone have any questions for Inam or?
I have a stupid question, right?
Yeah. There's no stupid questions, right?
You are doing the NASDAQ index, so I'm taking the investment analysis.
Okay.
What is the market portfolio? It's a S&P 500 portfolio. So is the market portfolio or NASDAQ? Like one of them index is a portfolio, or all of the different index compounded together is the market portfolio.
So I see your question. So are you trying to ask whether
the beta risk?
Right, exactly. Yeah. I see. Yeah, that's a good question because when you do investment analysis, they ask for a benchmark, right, to use, and usually people use S&P 500 and not NASDAQ 100. And the reason for that is because S&P 500 looks at the 500 largest companies on the US stock market, and they don't discriminate based off sectors. So they include any sector that a company is in. So therefore, because it doesn't discriminate what sector a company is in, it therefore better represents the entire market. And because it's the largest 500 companies, it therefore gives a very good picture of how the overall economy is doing, because it's the 500 largest companies in the US, and it doesn't discriminate what sector this company is from. While the NASDAQ 100 looks at the largest 100 companies on the NASDAQ exchange, not the US stock market, but only NASDAQ exchange, and they discriminate financial companies. So they don't allow financial companies to be in that 100 companies. So, and because NASDAQ have mostly tech companies listed on their exchanges, it's very much weighted towards tech companies. And tech companies doesn't represent the overall economy, right? They're just a part of the economy. That's why people use S&P 500 usually when they talk in like investment analysis. They use S&P 500 because it's a better representative of the entire US economy.
So you mean the NASDAQ stocks mainly about the growth stocks, right? Not the value stocks.
Exactly.
So
growth stocks.
So right now the NASDAQ those customers, are they losing a lot of money?
They lost people having NASDAQ tracking NASDAQ 100 lost a lot in 2022, but because year to date in 2023, actually NASDAQ 100 has outperformed S&P 500. I think year to date, a few days ago, it was almost 20% NASDAQ 100, while S&P was around 12% year to date performance. And that's because, tech companies have done better than expected on earnings this year. It's kind of picking up again. To 2022, tech companies did very poorly. Earnings were almost, going down, and it was expected to go further down. Now it's kind of picking up again, and the possibility that the rate hikes might end this year, end of this year.
How do you think about right now? Yesterday just First what's that name? First Republic, right? It's going to collapse, and the startups, I guess they cannot raise capital anymore. So is that a big factor to NASDAQ index?
Actually not. And the reason for that is NASDAQ 100 excludes financials. So that's one of the reasons why NASDAQ 100 has outperformed in 2023, is because the NASDAQ 100 does not contain any financial companies, meaning any banks. And because banks obviously did poorly because of the situation with mid-level banks, right? S&P was dragged down. Dow Jones was dragged down because they contain financial companies. NASDAQ 100 doesn't contain financial companies. That's why it outperformed, especially greatly when this banking turmoil happened. So in that way, NASDAQ is suggests that it can do well during some financial crisis because they're not containing financial companies. They're containing tech companies.
How to trade based on NASDAQ?
So you can trade, if you want to invest in NASDAQ 100, it's the ticker QQQ by Invesco. They're the fund provider, and their fund is called, or the ticker for that fund that tracks NASDAQ 100 is called QQQ. That's the best way to invest in NASDAQ 100.
If we work in a feeder company, do we use some special instrument or computer like those Bloomberg terminal to do that trading?
No, you can trade NASDAQ 100 on any brokerage platform like Robinhood, like TD Ameritrade, Whitbull. So any brokerage platform, you can trade NASDAQ 100, just like you can trade S&P 500 on any brokerage platform. You can do that for NASDAQ index funds as well, funds that track in NASDAQ indexes.
Okay, thank you very much, Inam. I don't have any questions.
I have a question.
Okay, good.
So I just want to ask for, do companies get taken out and replaced, let's say if they're not performing too well in an index?
Correct. So, for example, different indexes have different, we call requirements, like a requirement for a company to be included in an index. We call that requirement for eligibility requirement. So if an index have certain eligibility requirements, for example, an index can have an eligibility requirement that a company needs to be large cap, meaning it needs to have, let's say, more than 10 billion in market capitalization, right? So that's a requirement. It's a rule that has to be followed. Now, if a company that is included in the index starts at, let's say, 12 billion in market cap, right? So it is eligible because it's above 10 billion, which is the requirement or the minimum. But let's say that company gets included in the index, but for example, in 2022, its market cap falls down dramatically. Let's say it goes from 12 billion in market cap to 7 billion, 6 billion. Now, because it doesn't meet that requirement any longer, usually it will be taken out of the index, meaning it will be deleted from the index. And when will it be deleted? That depends on the specific index, because they only delete companies usually based on specific times specified in the index. And the reason why they specify a specific time in the index is so the fund providers have plenty of time to prepare for deleting or removing that company from their fund. And usually that can be quarterly. Otherwise, it can be semi-annually or even annually, meaning that, let's say, the company that no longer has a market cap of 10 billion has now 8 billion, but the next period for when you're actually swapping the securities in the index. So when you change securities in the index, it's called rebalance and reconstitution period. But let's say that rebalance and reconstitution period is in 5 months from now. That means that that company that didn't meet the requirement will still be in the index until the next period where you're kind of rebalancing and reconstituting the index. So if it remains ineligible for that time period, it will be deleted when the next period of reconstitution, rebalancing comes in place. So yes, they will be deleted if they don't meet the requirement specified by the index. And what that requirement can be so many, right? Because if it's a factor-based, it can be based on the factor. Let's say the company doesn't meet the dividend requirement, yield requirement, it gets deleted. If it doesn't meet the market size requirement, it gets deleted, or whatever other requirement.
I see. And I guess you answered my second question was so the funds actually deleted then once the index
Exactly.
deleted. Okay.
Exactly.
I see.
And
is it sorry,
yeah.
go ahead.
No,
Is it also true that the indexes outperforms their mutual fund counterparts?
yeah, usually that's the case. And the reason for that is because so the index doesn't include transactional cost, doesn't include timing necessarily on the different costs related to actually trading the companies, right? It's just the index is just like a hypothetical portfolio. So it doesn't include the transaction costs into the performance of the index. And that's usually why when you compare the fund performance and the index performance, the fund performance is usually a little bit below, not much below, because if it's a lot below, that means that we have created an index that is so hard to track that the fund is not having the same performance as the index. The goal is to really have the index and the fund to have the same performance. If not the same, it should be not deviating a lot from the index performance. And if it does deviate a lot, that means that we need to change the index somehow so it's easier to trade. So the asset manager that actually runs the fund can match the performance of the index.
I see. Very informative. Thank you so much.
Of course. You're muted, Shinji.
Shinji, you're muted.
Sorry about that. Lani, would you like to do the closing?
Perfect. Does anybody else have any question before we end our session today? Awesome. Well, thanks again, Inam, for your time, sharing your knowledge with us. And again, we have our last session tomorrow, last event of the semester. So I look forward to seeing you again tomorrow.